Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionsPlay. And today we're here to talk about a topic that I don't cover very often, but is very important, I think, for many investors. And I specifically refer to investors as those of you that buy and hold stocks typically for longer than a few days to a few weeks, where you might hold on to a stock that you own for a few months, perhaps even a few years, and how you can utilize options for those specific types of ideas. So we're going to talk about how to use longer dated options for your longer term investments, and what are some of the benefits and limitations that you need to be aware of when you're using options for these types of strategies. So before we jump into this, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy any of the specific securities that we are using as examples today, which are purely for educational purposes only. So today what we'll cover is a few different things. We'll talk about what are longer dated options, just to define what they mean. When should you use these longer dated options? The optimal expiration dates and strike prices to look for when you're using long dated options. I want to talk to you some about the strategy tips, and then discuss what we call a poor man's cover call, which is really taking this one step further, because typically we think of our long-term investments as stocks that we own, and sometimes we may sell cover calls against those long-term investments. Today, we're going to talk about how to sell cover calls against a long-dated option, or what we typically call a poor man's cover call. And then we'll try to go through a few examples and open this up for Q&A here at the very end. But the primary thing that I want everyone to walk away from today's session is a clear understanding as to how you can utilize longer dated options to reduce your risk for longer term investments. And the key here is to reduce your risk. So let's first define what longer dated options are. And this is really where sometimes it can get confusing, but it's really actually quite simple. It's simply an option that expires greater than 9 months from today is what we typically consider as a longer dated option. You can have bullish call options or bearish put options, the same way you have short-term options with calls and puts. So those do not change. Nothing changes between long dated versus short dated options. The only difference is the time to expiration is greater than 9 months. Now, when you have a bullish view, this is really where the long calls provide unlimited upside in exchange for limited downside risk. And then for bearish strategies, you have substantial downside potential return with limited upside risk. And the key here is really the limited part in terms of risk. And this is really the key benefit of using options to take a longer term view, is the limited risk versus what is typically considered unlimited or very substantial upside for the directional view that you have. So when should you consider using these leap options? Generally speaking, there are two scenarios. One, when you have a long-term bullish outlook on an underlying stock, or you need protection against a downside move. The reason that we typically don't use puts for a long-term bearish view is that typically, or at least statistically speaking, bearish views do not last nearly as long as longer term bullish views. Typically, bearish views are much more short-lived. They're better suited for shorter dated options. Usually, we don't use longer dated options to take a long-term bearish outlook. Now, yes, you can certainly point out in times of history where you may have had a long-term bearish view on a specific stock or ETF or the broader markets, but it's very hard to know that at the time that those markets were going to last for such a long amount of time. We generally are not bearish for more than a couple of months at a time, which is why when you have a shorter dated bearish view, you tend to use shorter dated options for that. So when you think about longer dated puts, they're really more for protection. When you're thinking about concerns about perhaps a recession that may be coming up. So when we talk about bullish outlooks, this is typically where most long-term investors are. You have a long-term bullish view of a specific stock or a specific sector that you're looking to gain some exposure in. This is really where you might use a longer dated call option as a replacement strategy for buying the stock. And generally speaking, you need to have a bullish outlook that's greater than 3 months, meaning if you have a bullish outlook that's only a month out, you're better off using a shorter dated option. Otherwise, if you have a view that's greater than 3 months, meaning you intend on holding a stock for more than 3 months, that's when you might want to consider using a longer dated option. And lastly, mitigate downside risk. And this is really where I think why I think the current environment that we're in is a great opportunity and time to discuss these longer dated options. Because if you think about the last 10 years in terms of the bull market, we certainly are near the end of that bull market. There are some concerns that we may be entering a bear market, but there are still plenty of investors that are, that think that this can go on for quite some time, that maybe the geopolitical tensions start to ease a little bit. We can start seeing stocks back near all-time highs again. There's certainly plenty of analysts on the street that believe that. But right now, there's no doubt in anyone's mind that the risks are certainly greater right now. So this is really where using a longer dated options can help you mitigate some of those downside risks, whether those risks are related to earnings, whether they're related to the fact that markets are overbought. And if you think about markets from a longer term perspective, certainly overbought can be a way to describe the current markets. An extended rally, we've had over a 15-year bull market since the 2008 financial crisis, 14-year bull market. That's a very long bull market. Perhaps you're concerned that there's some downside risk, but you think that in the short run things can still continue to move on, or just simply lofty valuations, which again I think can be a definition of the current market we're in. Any of these particular scenarios or environments lend themselves to using risk mitigated strategies like a long call option. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. And then if let's say you have a longer term bearish outlook, and generally speaking, you only have a bearish outlook that's greater than 3 months when you're heading into what you consider as a big recession, right? Think 2008 financial crisis, think dot-com boom, think 87. These things don't happen very often. They happen only once a decade, once every decade and a half. We certainly are approaching that timeline from the last major recession. So this is potentially a time where you could use a longer dated put option to hedge your downside exposure for your portfolio. It's usually to hedge either a specific stock that you have a bearish view on, or a portfolio of stocks that you have a bearish view on. And it's important to understand that this is a strategy that you generally use when moving to cash or moving to more defensive assets is not an option. What I mean by that is, for whatever reason, you need to stay invested in the current stocks that you own in your portfolio and you're trying to protect against a downside move. If you have the opportunity or the option to sell your assets, move them into cash, move them into fixed income, move them into more defensive assets like gold or oil or something like that, or real estate, you should always explore those options first before you buy a put option. And the reason is because buying a put option is extremely expensive. So you only use put options as a form of protection as a last resort. Does that make sense? Please type 2 into the chat window if that makes sense to you. If you have other options like moving to cash, moving to more defensive assets, using other strategies to protect your portfolio, you should always explore those options first. But some of you, maybe you have portfolios with low cost basis and you don't want to change those holdings, or maybe you rely on dividends and you need to hold those specific stocks and you don't want to sell them. That's the only time when you want to explore puts, because put options are expensive as a protection strategy. So What I want to do today is spend some time comparing buying the stock to buying a longer dated option. We'll talk about the pros and cons of each strategy. We'll talk about the symmetrical versus asymmetrical risk nature of owning the stock versus owning an option. And we'll also look at the break-even analysis. How much does the stock need to rally before the option strategies are profitable versus the stock strategies? So we're going to use CNQ as a starting point, as an example. CNQ, one of the strongest stocks in the market, trading near all-time highs. Perhaps you think that this can continue to move higher here, but there's also downside risk. Right now there's a lot of geopolitical risk around oil. If things resolve themselves or tensions start to ease in Russia, we certainly can potentially see oil stocks plummet as a result of that, or oil price itself start to plummet, and oil stocks obviously would come along with that. So there's downside risk here. And I think that downside risk protection is important for a lot of investors who are thinking about getting into oil stocks. So this is really where I want to look at CNQ as an example, because if I buy 100 shares of CNQ, my max reward is certainly unlimited, but my max risk is quite high. It's $73.81. Now, the benefit of buying a stock is the fact that the break-even price is the price that I pay for the stock, meaning if the stock even ticks a penny higher, I will start making profits. If the stock ticks a penny lower, I start losing money on the trade. So what I have here in this scenario of buying the stock is what I would consider higher risk with lower break-evens, meaning the break-even cost of my stock is the price that I pay. So even if the stock goes to $73.82, I will start being profitable on that trade. So, and what I have is symmetrical risk to reward, right? So if the stock goes up by $1, I make $1. If the stock goes down by $1, I lose $1. I know exactly how much money I can potentially make or lose depending on where the stock lands sometime in the future. And what we're going to do is we're going to compare that to buying a call option. I'm going to look at buying the January 2023, which is about a little over 9 months from expiration. And I'm going to look at the $70 call option. This is currently trading at $12.70. And what you're going to see is that I have, in this particular case, asymmetrical risk to reward. What do I mean by that? Is that my max reward remains the same. My max reward remains unlimited in both scenarios, whether I buy the stock or if I buy the call option. But if I purchase the stock, I'm risking $7,300 versus $1,200 in the option. So I'm risking a fraction of what I would need to risk if I was to buy the stock itself. I'm actually only risking 17% of the stock's value when I buy a call option versus buying the stock itself. So I'm reducing my risk by over 80% when I'm buying the option versus buying the stock. Does that make sense? Please type 3 into the chat window if that makes sense to you. So one, what I'm trying to do is reduce my overall risk, but there are some trade-offs. It's not just as simple as I can reduce my risk but still have unlimited upside. The trade-off is that I have a higher break-even price, because what I have to consider is my strike price, which is $70, plus the $12.70 that I pay for it. When I add those two numbers together, I get my break-even price of $82.70. What that means is that by January 2023, the expiration date of this option, the stock has to be above $82.70, which is roughly 12% higher from where it's currently trading today. The stock has to be 12% higher just for me to break even, which means if the stock rallies 12% over the next 9 months, I don't make any money from the strategy. I'm just breaking even. The stock has to be above 12% in 9 months in order for me to be profitable. So that's the trade-off that you make when you take on less risk with the call option versus how far the stock needs to rally before your strategy is profitable. So the question is, what should I do? Should I buy the stock? Should I buy the call option? And the answer comes down to how bullish are you on the stock, or where do you think the stock can go in the next 9 months? And you can look at a historical chart to look at the trend and see roughly from a projection perspective, how far can the stock go? So if you think the stock can go to $90, $100, which is significantly higher than the 12% that it needs in order for you to break even, then it might be worth your time. Because if the stock rallies to $100, then you're going to make, in this particular case, roughly $17, $18, while you're only risking $12.70. That's a risk reward ratio that's pretty strong. But if you only think the stock is going to reach $85, then perhaps this is not the right strategy for you. At least the call option is not the right strategy for you, because you're just barely above break even. So that's really the question that you have to ask yourself when you're thinking about these call options, is how far do I think the stock is going to move in the next 9 months, and whether or not I'll be able to turn a profit on this specific strategy. This will help you determine, when we look at CNQ, that will help you determine where you think the stock can be. And if you look at the stock, right, this was a $50 stock just in December. It's now a $77 stock. So do you think this $77 stock can move up to $100 in the next 9 months? That's really the question that you have to ask yourself. That will help you determine whether buying the call option or buying the stock will make more sense. Does that make sense? Please type 4 into the chat window if that makes sense to you. And someone just said in March 2020, this was a $20 stock. Exactly. So, if you had bought a long-term option back then, a $20 call option, and the stock is now trading at $70, you would have a very nice profit on your hands from that strategy, right? I'm not saying that you should go out there and buy CNQ right now. I certainly am not, in any way predicting where oil prices will be 9 months from today. But this just shows you an example and how you go about determining whether you should buy the stock or whether you should buy the option when you have this longer term bullish view. Okay, we'll go through one more example. We're going to use Barrick Gold. We're going to use the gold options because gold options right now are relatively, let's just use a real example here. We'll use OptionsPlay, and I'll show you how to access OptionsPlay for anyone who has not utilized this platform here before. And I'll just show you the two strategies side by side. Gold has certainly had a bit of a strong move here over the past few weeks, especially with regards to Russia. We started to see the move even prior to Russia, but the major thing for gold from my perspective is this downtrend here, and Barrick Gold was broken out here in February, and we've seen a strong move here to the upside. It's trading near recent all-time highs, but certainly well shy of the $38, $39 highs that we saw back in 2020 or so. So if we look at that, let's look at Barrick Gold. And I'm going to use the January $30 call options, which are currently trading at about $3.50. And what we'll look at is buying 100 shares of the stock, which will cost us about $3,000, versus buying the option, which will cost us $350, which is roughly a little over 10%, about a little over 11% of the stock's value to buy a call option for January versus buying 100 shares of the stock. But the big difference here between the two is that if I buy the stock at the current price is my break-even price, $30.34. But if I buy the call option, my break-even price is $33.50, which is, again, about 10, 11% higher from where we are currently trading right now. So I have to ask myself, do I think the stock can trade 10, 11% higher over the next 9 months before this is worth my while? And I think for a lot of gold bugs and a lot of people who are concerned about where central banks are heading and where the world is heading from a geopolitical perspective, I think seeing gold or some of these gold mining stocks 10, 11% higher in 9 months is certainly achievable considering where the stock has been over the past few years. And that's really the calculus or the math that you have to do when you're making these decisions, right? So in a year from now, in January 2023, if the stock is currently at $38 back to where it was trading in 2022, let's say it's trading at $38 or $39, as you can see, if I bought the stock, I'm looking at a 28% return. If I buy a call option, I'm looking at 156% return. So this is really where you can utilize these tools to get a better understanding as to which strategy is best suited for you. Because in one strategy, you're risking $3,000. The other strategy, you're risking $350. So when I'm able to risk only 10, 11% of the stock's value, and I can potentially get this type of return, that's when it might make sense to me. But again, the risk that I'm taking is the fact that if the stock doesn't move, here I'm risking nearly 100% of what I'm risking. But even 100% of what I'm risking is only a fraction of what I'm risking when I buy the stock. So that's how you can go about determining which strategy is best suited for you. And depending on the stock that you're looking at, how much upside do you think there potentially is in that particular stock, and whether or not you can use that historical price to determine which strategy is best suited for your portfolio. Does that make sense? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 5s. Okay, so let's talk a little bit about, how does this affect me as a trader? So think about this from another point of view. When you think about a longer dated call option or longer dated option in general, this is a limited risk strategy that will give you a capital efficiency, because if you buy 100 shares of Barrick Gold, you're going to need about $3,000 in cash to do so. Using the option, you only need about $350 in cash. You get similar exposure. It's not identical, but you get similar exposure but then you still have 90% of the capital that you can do something else with. You can invest it in bonds and something safer and generate some income. You can perhaps put it in a blue chip stock and earn some dividends on it. There's a lot more things that you can do with the freed up cash that you have when you're using a longer dated option versus the stock itself. So capital efficiency is certainly one of the things that is the primary benefit of using one of these longer dated options as an investment versus as a short-term speculative tool. The second reason that you might want to use a longer dated option is the fact that it has relatively low time decay per day that you hold on to it. So when we talk about options, one of the major things that are working against you when you're buying a call option or any option is time decay. And when you buy a longer dated option, each day you hold on to the option, the time decay is actually fairly negligible per day versus if you bought a 1 month option. Because some investors will ask me, well, why wouldn't you just buy a 1 month option? It'll cost you substantially less and you can get some more leverage. Well, that is true, but for every day you hold on to that 1 month option, it's going to decay at a much, much faster rate, which means that if you buy a 1 month option 9 times over, the stock has to rally substantially more than 11% over the next year before those 9 options will give you the same return as that one 9 month option. So buying a longer dated option gives you more flexibility on time. And because the time decay that you hold per day that you hold on to the option for is significantly lower. Those are the primary benefits of using these longer dated options versus a shorter dated option. But it also has some limitations. One, it's just the size of the move that's required in order to profit. In the examples I showed you, you needed about 11 to 12% move in about 9 months' time before you're profitable. Not every single stock you look at do you think that there's going to be an 11, 12% move over the next 9 months. It really depends on the stock. It really depends on the sector, where you think that the market potential is. That helps you determine whether it's a suitable product to use a longer dated option for. The second thing you have to consider is that they're not as liquid. These longer dated options tend to have wider bid-ask spreads. They tend to have lower open interest and volume. So which means that you simply may not get as good of a price on these options as you would if you're trading a front month option. So you may have to pay a little bit more above the midpoint in order to get these orders filled. They also do not receive dividend income. So if you own the stock, you get the income. If you own the option, you don't receive that income. And they're not available on all stocks. They're not available on all optionable stocks. They are available on most of the widely traded larger market cap names. But if you start to move towards the smaller cap names, you may not have options that are longer dated. So you do have some limitations as to which symbols you can trade longer dated options on. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. So now that we kind of discussed the strategy, what are the pros and cons, the benefits and limitations, and we kind of have a better understanding of how you can utilize these strategies, let's talk a little bit about kind of the optimal strategy. One, we talked about this, the expiration dates are simple. Anything longer dated than 9 months out. Usually, from my perspective, the optimal expiration date is roughly 1 year from expiration. When you go out more than 1 year, this is really where, the lack of liquidity can sometimes be a major problem. So I generally don't like to go out more than 1 year. And certainly as we start to approach a 3 months from expiration, 2 months from expiration, roll them out to the next year instead of buying a 2-year option. Some options, you can buy a 2-year option on, but I'm not a big fan of that. I think going out 1 year is typically as far as you should go out with these strategies. When you're thinking about strike prices, this is really where, when you think about these longer dated options, it's best to use an in the money strike price. So a strike price that has about a 60 to 70 delta. So if we go back to our Barrick Gold example here, when I used the $30 strike price, that strike price was a 58 delta. So just around the 60 delta range. So you can also look at the 29s, which is the 62 delta. The delta tells you the approximate probability of the stock being above that price at expiration. So if I look at a January $29 call option and it has a delta of 0.62, that means there's roughly about a 62% chance the stock will be above $29 by the January 2023 expiration date. And that's why we use deltas to choose our strike prices. It gives us a probability-based approach to selecting our strike prices. A lot of traders struggle with selecting strike prices. There's a lot of different strike prices. How do you choose which one you use? And if you use delta to select your strike prices, you will have a much more consistent approach to your trading, because you'll have a good sense of what is the probability of success on my trade. And if you have similar probability of success from one trade to the next, you'll have far more consistency in understanding what your profits are going to be, or what your chances of profits are going to be, versus if you're just kind of winging it every single time you choose a strike price. Sometimes you choose a strike price at a high delta, sometimes you use a low delta. You're just going to have inconsistencies in your trading, and you're not going to have a good cohesive understanding as to why certain trades work out and others don't. So that's why I suggest using a 60 to 70 delta strike price. These are in the money options. They have lower extrinsic value, which means that you have lower time decay for each day you hold on to it. And the cost will usually be anywhere between 15 to 50% of the underlying stock's value. The more volatile names will have a larger percentage. The less volatile names will have a smaller percentage. And the few examples that I showed you, CNQ and Barrick Gold, both were about 11 to 12% of the underlying stock's value. So certainly on the lower end of the threshold in terms of how much capital it requires versus the stock price itself. Does that make sense? Please type 7 into the chat window if these two expiration dates and strike prices make sense to you. Perfect. Okay. So I just want to show you, the different strike prices, right? So we talked about using in the money options versus out of the money options. And I just want to show you the difference between the two. And the reason that I tell investors to look at using in the money options is because, you know, we think about these strategies as a stock replacement strategy. So what you want to do is you want to pick a strike price that is similar to owning the stock. So you have choices. You can use an in the money option, you can use an out of the money option. And I just want to show you how an in the money option mimics a stock replacement strategy versus buying an out of the money option. Certainly has benefits, but doesn't really replicate owning the stock. So what I have here is I buy 100 shares of a $100 stock, and I have how the stock gains and you know, shows gains and losses depending on whether the stock rallies or declines. So it's a $100 stock, right? So if the stock declines to $50 or if it rises to $150, my stock will give me the appropriate profits and losses. So if the stock declines by $15, I lose $15. If the stock declines by $50, I lose $50. And if it gains $20, I make $20. If it gains $50, I gain $50. So the first column, I think, is pretty self-explanatory. If you buy the stock, if the stock goes up by $1, you make $1. If it goes down by $1, you lose $1. The next column, what I have here, is buying an in-the-money long-dated option. And as you can see here, it doesn't give me the exact risk profile of owning the stock, but it gives me a risk profile very similar to owning the stock. Because if 1 year from today, the stock does not move, I don't have a big loss. I have a small loss here of $5 versus if I bought the stock, I would have no loss at all. If the stock gained $20, I would gain 15. If the stock gained 50, I would gain 45. So I'm just always $5 behind owning the stock. If the stock decreased by $15, I would lose 20. But at some point, if the stock loses more than what I pay for the option, I don't have any additional losses. So what I'm doing is I'm protecting myself to the downside when the stock has an extreme loss to the downside, and to the upside, I have a payoff that's very similar to owning the stock. And that's really what, at least from my perspective, when I use options as a stock replacement strategy, my priority is to have a payoff that's similar to owning the stock that also protects me if the stock declines substantially from where it is today. Does that make sense as to why the in the money option, or at least shows you how the in the money option provides that stock replacement strategy? Please type 8 into the chat window if that makes sense to you. Perfect. And then there are some investors that will ask me, why not use an out of the money option? And the answer is you absolutely can use it. Just understand that it's not a stock replacement strategy, because if the stock doesn't move, you have a $5 loss. If the stock starts to move, you don't really see a lot of gain until the stock makes a really big move, right? And even when the stock makes a really big move, you're not quite getting the same upside as owning the stock itself. But you do have very strong downside protection. If the stock declines even moderately, you have limited losses. So it's not that the strategy is better or worse, it just has a payoff graph that's very, very different from owning the stock, because you have almost no losses to the downside, but the stock has to rally very substantially before you see any upside too. And perhaps that's what you want. It's not to say one strategy is better than the other. It's just to say that an in the money option provides a strategy very similar to owning the stock, versus buying an out of the money option gives you a very different payoff graph. There's nothing wrong with that payoff graph. It's just very different from owning the stock. And you have to ask yourself which one's best suited for you. But for me, when I'm thinking about a long-term investment, I'm thinking about buying the stock versus buying a call option, the in the money call option is the one that I would choose, because it gives me a risk payoff graph similar to owning the stock. Okay. And lastly, just some trading tips. When you think about these longer dated options, you should really think of them as owning the stock, right? This is the whole point of why I'm trying to show you this as a stock replacement strategy, because you want to enter and exit as if you were trading the stock, meaning you enter when you have that long-term bullish or bearish outlook. So whenever you determine, it's time for me to buy the stock or it's time for me to short sell the stock, that's when you buy the long dated options. The entry strategy is the same. The exit strategy, generally speaking, needs to be, because this is an option and it has an expiration date, you need to have a strategy to exit these trades before the expiration date. If you need to continue holding on to this trade because you think the stock can continue to run, then you simply need to roll those options as they approach expiration. I usually like to roll them about 2 months before expiration, because the whole point of owning a long dated option is to have options that are not expiring soon, because the time decay starts to accelerate as you reach expiration. So you'll always want to exit before expiration. If you need more time, start rolling it 2 to 3 months from expiration. And then you need to also consider setting stop losses based on the stock price itself. So if I bought CNQ at $73 or a Barrick Gold at $30, and I tell myself, if the stock gets back below $27, then I would consider this bullish view as incorrect, and I would probably consider closing out my trade. Well, then once the stock gets below $27, doesn't matter where the option is, you should also get out of the option, because again, the option is just a replacement for the stock. So if you're going to take profits on the stock, take profits on the option. If you're going to cut losses on the stock, cut losses on the option as well. The option is just a vehicle for you to gain exposure to the stock. So use the stock as your gauge to determine when you're going to exit that trade, either at a profit or a loss. Does that make sense? Please type 9 into the chat window if that makes sense to you. Perfect. So one last variation and one last addition you can make to the strategy is what we call a poor man's cover call. Because again, think of the option as a stock replacement. If you own the stock, you might be inclined to sell cover calls against that stock to increase your income on that asset. You can do the same thing when you own a long dated call option, because a long dated call option is very similar in risk profile to owning the stock. You can sell call options against the long dated call that you own. The strategy to do with this is that you want to sell short dated options, 1 month options. So for example, if you own that January 2023 Barrick Gold call option, you're going to sell monthly options against that long dated call option. So you use the same method as if you were owning the stock. You just simply sell calls against that. So if I own the January 2023 $29 call, then I might sell, in this particular case, right now, the April 14th would be the monthly option that I would sell. Maybe I'd sell a $33 call option against it. Whoops, I want to sell it, not buy it. And so as you can see, I'm paying $4.55 for the January 2023 $29 call option. But over the next 31 days, which is roughly 10% of the time, or almost exactly 10% of the time between now and the expiration date, I'm going to collect 53 cents. So I'm actually collecting more than 10% of the premium of the long dated option in about 10% of the time of the long dated option. And what the goal here when you're selling a poor man's cover call is to reduce the cost of the long call and reduce the time decay that you're paying for that long call by selling short dated options against it. And as long as the stock doesn't rally above $33 by the April 14th expiration, I get to keep my 53 cents and I can sell another call option against it. And I would select my strike prices based on where the stock is when I enter that cover call. So the stock is currently trading at $30.31. That's going to help me determine with the $33 strike price. But if, let's say, next month the stock is trading at $32, then I might want to sell a $34, $35 strike price to 1 month from today. So you're constantly adjusting your strike prices based on where is the stock when I sell that cover call. And when you do this, when you sell a stock, you can usually collect 2 to 3% per year of the underlying stock's value. When you're doing on a leap, you can collect 10 to 15% per year. So you're simply increasing the amount of capital that you are collecting because it takes less capital to buy the leap versus buying the stock. So you can see a pretty significant boost in terms of how much you're reducing your cost basis per year on the leap versus the stock itself. But the one thing that you must remember when you're doing this on a leap option is that you must roll your short calls. I generally recommend doing it 2 to 3 weeks before expiration to avoid assignment. You never want to get assigned on a short call option or a covered leap when you own the option itself, because you don't own the stock. And if you get assigned, you're going to end up being short 100 shares of the stock. You don't want to be short 100 shares of the stock because you will probably be liquidated from that. And if you're not liquidated from that, you've effectively hedged any upside that you have on the long dated call option that you own. So to avoid ever being in a position where you are assigned and you don't have the stock to deliver, you always want to roll out your poor man's cover call 2 to 3 weeks from expiration. Does that make sense? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so that covers what I wanted to share with you here today. I really hope that this was helpful in giving you a better understanding as to how to think when you have a longer dated bullish or bearish view on an underlying stock or ETF, where you're considering buying the stock long term and you want to compare buying the stock versus buying the call option, how to go about doing so, how to select your expiration dates and strike prices using the OptionsPlay platform. Many of you on this session here today are familiar with OptionsPlay. You already have an account. You can log in using tmx.optionsplay.com. For those of you that are brand new to OptionsPlay, you can sign up for free access at tmx.optionsplay.com. And this is one of the key benefits of being a Canadian investor, is that the Toronto Montreal Exchange is paying for your free access to OptionsPlay Canada. You can use the full-fledged platform for all Canadian securities completely free of charge when you register at tmx.optionsplay.com. It'll give you access to this tool that I've showed you here today so that you can compare any two strategies side by side, and you can modify any strategy, any expiration date, any strike price, so that you can compare buying different call options versus buying the stock using the P&L simulator, and seeing how each strategy will perform depending on where the stock rallies to in the future. That's really the key to help you determine, should I buy this longer dated call option? Should I buy a shorter dated call option? Should I buy it out of the money, at the money, in the money option? You can compare any three strategies side by side so that you clearly understand what the risks and rewards are of each strategy before you implement them in your real portfolio. So with that, I hope that this answers many of your questions that you might have regarding longer dated options. And at this point, what I'll do is I'll open this up for Q&A. If you have any questions, there's both a Q&A section and a chat session. If you don't mind, please type your questions into the Q&A window, and I will answer your questions out of the Q&A section. Someone says, I own 500 shares of the stock at $65. I need some ideas to play some long-term options trades. So Amin, hopefully today's session gave you some of those ideas. How to protect a portfolio which has more than 20 securities. So Winston, that depends on what those 20 securities are. If those 20 securities are pretty well diversified across different sectors, large cap, small cap, then you want to use a broad-based index, maybe XIU, which is the S&P TSX 60. If let's say you own those 20 securities are all banks, then maybe you might want to use XFN, which is the bank ETF. You generally want to find something that mimics those 20 securities as closely as possible. So look at the concentration of those 20 stocks. Are they well diversified? If they are, use a broad-based ETF. If they're not diversified and they're all kind of in one sector, or maybe there's a bunch of mining, there's a bunch of mining stocks, and you want to use a mining ETF, just find an ETF that's closely mimics your portfolio. Do I need to buy put options separately? Yes, put options and call options are separate. Can you please compare put leaps to synthetic puts? Sure, the platform is really flexible. You can do anything that you want. So if you want to look at bearish short synthetic stock versus buying a put option, you can do any two strategies side by side. So I can compare on bear gold. If I'm bearish on gold, for example, what it looks like to trade a synthetic stock, short synthetic stock specifically, versus buying a longer dated put option. So here's a January 2023 $30 put option, or maybe a $32 put option. You can compare any two strategies side by side and then use the P&L simulator and say, well, what happened if gold, or a Barrick gold rather, goes down to $24? What's my potential return? What's my potential profit on the strategies themselves? You can do any two strategies side by side. Winston's asking when to exit the trade from a long-term option. Again, the exit strategy should be based on when you want to exit the stock itself. So when would you determine that your long-term view is no longer applicable, or if it reaches your take profits or reaches your stop loss levels? That is the time at which you would consider closing out the trade. Is it advisable dollar cost average if one is using longer dated options, such as a 2-year time frame? So dollar cost averaging is really based on the size that you have, that you're trying to trade, right? So if, let's say you are trying to establish not just 100 shares of Barrick Gold, you're trying to establish 500 shares of Barrick Gold, that's where dollar cost averaging could make sense. You don't want to just buy 5 contracts all today. You might want to buy 1 or 2 contracts today, wait a few days or a few weeks, and then buy another 2 contracts. This way, you're not all in at a single price. But again, Don, that depends on how many shares you're trying to buy. If you're only trying to buy 100 shares, you won't be able to dollar cost average. But if you're trying to buy 2, 3, 500, or anything more than that, then certainly dollar cost averaging is something that you might want to consider. What does rolling over means for the option? So let's say you buy a January 2023 option, and let's say it's now November 2020. So you're only 2 months away from expiration. At that point, what you might want to do is simply extend the time of the option. So rolling it is simply closing the existing position that you have in the January 2023 option, and then at that point, maybe buying a January 2024 option. So the closing of the existing trade and opening up a new one, that process is what we call rolling an option. Unfortunately, I don't know if there's any movement on Tastyworks Canada just yet. I think the best people to ask on that front is Tastyworks. When using a poor man's covered call, at which stock price move do you decide to roll up or down the leap? I'm not sure I understand the question, because the poor man's cover call doesn't roll up or down the leap itself. The leap stays the same. What you're rolling is a short dated call against that. Can a poor man's cover call be only made in non-registered accounts? So if you're talking about a tax-deferred account, I believe you will have limitations, and you probably will not be able to do that in a non-registered account. What would be the criteria to select the best stock for leaps? That is a very, very, I would say, personalized for each person. Everyone has investments in different sectors, different views that they have on the broader markets. I don't think that there's a set of stocks that people want to own for the long run. That's a very personalized question. From my perspective, I can tell you personally, I need to have a fundamental outlook on the underlying stock. I need to have a stock. I need to know that the stock is growing its revenues and its profits. That is a key fundamental thing that I look for. It has to have a reasonable valuation assigned to that stock based on the growth rates that it currently has exhibited, or the growth rate that's expected, before I would consider it as a long-term view. And then lastly, I use the charts to help me time the entry of that directional view. So it's a combination of a few different factors. Now, those factors are going to be very different for different people. Some people like to invest in high growth sectors. Other people like to invest long-term in very low growth sectors where it's very stable. So these are all very personal questions. And those are some of the things that you have to develop as an investor, as to what do you want to invest in. I can tell you that from my experience, it's better to invest in companies and industries that you understand versus companies and industries that you don't understand, because it's harder for you to dig into that information that I just spoke about if it's a company or a sector that you don't understand. Will we have a recording of this presentation? Yes, we will make both the recording and the slides available. If I have to roll cover calls on leaps every 2 to 3 weeks before expiry, and expiry dates should be about 1 month out, then I will be rolling every 1 to 2 weeks. Is this correct? No, you'll be rolling at once a month because they're 1 month options. So you'll be rolling them once a month. Is this a bull call spread strategy? No, this is a calendar or diagonal strategy, the poor man's cover call. Is IV related to the underlying stock? IV is a metric of the option on the underlying stock, but it's not on the underlying stock. It's related to the option of the underlying stock. How much of a loss should you take on the leaps if they do not go with you? Ken, I tend to find that if you've lost 50% of the value of a leap, chances are this is a trade that's not working out. Everyone has their own thresholds, but usually somewhere in the 50 to 75% range is a good time to reevaluate your long-term bullish view and whether or not it still stands. On a poor man's cover call, should the first bullet point reduce cost basis 2 to 3% per year, not 2 to 3% per month. I think you'll be hard pressed to find cover calls that can reduce your cost basis by 2 to 3% per month. How do we enroll with TMX OptionsPlay? You can enroll for free at tmx.optionsplay.com, and no, this does not include access to OptionsPlay US. If you're interested in trading US options, you would have to go to optionsplay.com and register for an account there. That is a separate platform. Bob, great question. It is something that will be out in the year of 2022, but I don't have a date for you yet. I own a number of calls in a company that is being taken over at a price that is higher than my exercise price. I'm having difficulty selling the call just below the takeover price, as I'm happy taking profits and leaving some on the table for the next buyer. Will I be able to find a buyer for the calls that I'm long? Great question. I would say that this highly is dependent on the scenario of each stock. So unless you tell me the symbol of the stock, it's hard for me to answer that question. But the options will continue to trade and the stock will continue to trade until the acquisition is complete and the stock symbol conversion happens. So until then, you should still be able to find some liquidity from market makers on that symbol, generally speaking. What broker is best to trade in Canada? It's hard for me to say which broker is best, but I can tell you the things that I look for beyond just low cost. From my perspective, one of the major limitations in Canada is the ability to execute multi-leg execution. So as far as I know, you really only have about 3 companies that allow multi-leg execution in Canada for US and Canadian securities. That's Interactive Brokers, that's Questrade, and TD. So those are the 3 that I would prioritize because it allows me the flexibility to trade and utilize the benefit of options, because if I'm limited to single leg, then I'm very limited in terms of how options can benefit me, because there are benefits to buying options and there are benefits to selling options. And when you can't combine the two into a single strategy, you're kind of left in choosing one or the other. And I hate choosing one or the other. I want to have the best of both worlds. And that's what trading spreads allow me to do. So from my perspective, choosing a broker in Canada, choosing one of the ones that allow me to trade multi-leg trades is one that I would prioritize over anything else. What delta is best for a short-term call sold against a leap? We tend to find about the 20 to 15 delta is a good starting point when you're selling cover calls. And that's the same for if you're selling it against a leap or selling it against the stock itself. Do I like TSX or S&P 500 over the next 3 months? That's a very hard question to answer, just because it's very hard to predict the geopolitical risks of what's happening right now in Europe. But gun to my head, that it is not a particular place that I'd love to be in. What about additional risk of buying leaps in high IV conditions? So the higher the IV, the less attractive a call option is. And again, this is what I mean. You know, when you're limited to single legs, you have to choose: do I buy or do I sell? And sometimes neither one is best suited. And this is really where, from my perspective, this is why I prioritize brokers that allow me to trade multi-leg. So Ken, you're right. TD only allows multi-leg on US stocks. They don't allow it on Canadian stocks, which is why Questrade and Interactive Brokers are the only two in Canada that offer multi-leg execution on Canadian securities or Canadian options, and as well as US options. So from my perspective, I certainly think Questrade and Interactive Brokers are two that I would prefer, even though I'm not in Canada and I don't trade in Canada. That's how I view the brokerage space right now in Canada. With that covers what the questions here for today. And thank you so much for attending and taking your time out this afternoon. Thank you for submitting your questions and helping everyone else understand, you know, the questions. So what we will do is send out both the recording and the slides after we finish here today, so that you can review them and watch them again at your own pace. And please, if you have any questions, when you log on to your OptionsPlay Canada platform, there is the questions ask us button here on the upper right hand corner. You can always submit your tickets there, and our customer service team will be available to help answer your options related questions. With that, thank you so much. I hope you guys have a great trading day, and remember, sign up for a free account at tmx.optionsplay.com. Thank you so much and have a great night.